Ladies and gentlemen, my name is Steven Giorgella.
My name is Philip Tripotowski.
And this is the Automotive Market Minute that may or may not take just over a minute. Let's get in. All right, so first of all, we're going to talk about the April recap and what happened with our dealers across the country. We'll talk about consumer sentiment. We're going to talk about the market outlook and oil prices with a much deeper analysis from the great Phil Tripotowski. We'll talk about inventory and sales, and then auto rates and incentives. Here are the trends from the month of April, month over month and year over year. You'll see traffic dropped in April. We saw softening overall in the marketplace. What was interesting was it was extremely, it was much different in region to region. We've not seen these fluctuations region by region the way we did over the last month. You had dealers that sent us texts that, oh gosh, Castle Motors in Iowa, highest in like 52 years in business, 52 or 32. I'm not sure exactly what it was.
Record of 52 years.
Record of 52 years. Thank you. And then you see other dealers, I'm down 30%. And it's like, you know, so lead volume down about 6%, appointments down 10%, sales down 11%. We also know for sure, in talking to Michael Renault from Allen Ram Proactive Training Solutions, we know salespeople went a little bit on the recliner after having a big March. So we definitely know that happened. We know that was a thing. And then you'll see traffic year over year. I had mentioned this in the write-up that I made for last month. It seems as if last year when the Fed had gone 75 basis point hike, 75, 75, 75, 50, 50, 25, whatever the exact pattern was, it seemed as if last spring they had just gotten beat up like, 9 times straight. So they were like, buying a car? So it seemed like a lot less of them were searching, et cetera, a lot less motivated to search and such. So, but year over year, less lead volume, but actually more appointments and more sales year over year. Phil, go.
Okay, looking at consumer sentiment. Consumer sentiment is positive for the year. However, in April, we saw a 1.6% decline. Also on this chart, something that we normally don't touch on in too much detail is the average unleaded gas price. That came in at $3.66, up 1% year over year, but up nearly 18% year to date. We're going to tie that into why that matters.
Real quick interruption here, Phil. When is the last time our viewers looked at a yield curve? And the answer is probably not recently. So hit us with the quick stuff here.
Okay, well, currently on the right, this is what the yield curve looks like historically. You can see that normally when it inverts, when it then uninverts, that is corresponded to recessions. Look at 2008, 2001, the 1990s. And what's significant about today's market is today's inversion is the longest inversion since 1929. So why does that matter? And again, you can see that when this uninverts, again, that typically corresponds with a recession. Well, right now, if we look at GDP, the economy still looks strong at 2.5%. Unemployment is near historic lows, and the stock market seems to be quite robust. And so the economy is definitely still expanding. That doesn't really scream recessionary. However, we believe that we're nearing the end of that expansion. Again, see this and reference this chart on the right here. Enter oil and gas. In the 1970s, in 1990, and in 2007, those recessions were triggered by a rapid 40% increase in oil. So let
me go back real quick here. So one thing with regard to go back one, Phil. So one thing that I want to make sure I mention with regards to GDP and the positive numbers that are coming out on a quarterly basis, earnings, etc. I want you to look at the jobs that are being added and these exciting job reports. I'm not gonna. I try not to be politically motivated in any of these. I encourage you to go take 10 minutes and look at the jobs that are being added. And you tell me if you think the economy is really that well supported when it comes down to these historical unemployment lows. Because I think you'll probably find something that might tell you that, and Phil's about to go into it. It's like bad sign, but really good sign, but really freaking bad sign, but really good sign. And it's pretty easy to tell if you ask Phil and I why you could take and I'll let Phil use the famous words here in a second, but why you could easily take this information that's being put out to the public, twist it just a little bit to keep things rising and rising and rising. And there's a certain group of people that we call something. Again, I'll let Phil use it here in a minute. That it really feels like they are holding this thing up as high as they possibly can, as long as they possibly can. Go ahead, Phil.
Yeah, and so going back to oil, right now, oil is up, and there are rising geopolitical tensions in the Middle East. So there could be a significant oil shock sometime in the coming months, in the coming years, etc. For an oil shock to truly trigger a recession, oil will need to hit at least $111 based on past episodes. That would be right here. Currently, oil has not broken out of this resistance line. And so that is bullish. And as we look at where the market valuation is at, right now, today has sky high valuations. Today's market is just as expensive in 2000 and 1929, but there's a big difference. If you look at the S&P 500, the 5-year rate of change, today's 5-year rate of change is only 72%. In those past recessions, that rate of change was 150%. So that's a key difference here. And
so we're not going as crazy as we think we are. We're making a lot, things are exciting, but it's like this weird blend of like we've made a lot and things are expensive, but we're still making money, we still have employment, but so it's just this big mixed bag of good signs, bad signs, good signs, bad signs. Is that what I'm hearing?
Yeah, pretty much. Now we're going to talk about some good signs. The US dollar is starting to roll over at a major level of resistance here. You can see it's just starting to turn over. This is bullish for markets. Bullish for markets. If you look at the actual market, you can see this rising channel. The market's been largely above it. There's a big correction in April. It just retested it. It held the resistance. And again, given all of these factors, we believe that this is going to continue. This bullish momentum, perma bulls are going to continue to ride this. It's an election year. Do we really think that we're going to run into a recession right now in a election year?
So my question is if things went really, really bad, Phil, what is that bottom rising channel? What does that mean?
Well, that's another line of support. If oil were to skyrocket for some reason, shape, or form, you could expect probably a very large drawdown. And so as we're talking about, there's bullish things, there's recessionary signals. I don't anticipate a recession in the short-term future, but it does look like, as we were talking, and let me go back to this, it does look like we are nearing a period of the end of an expansion here. But again, in order to stop that expansion, there needs to be a catalyst, and that was the purpose of today's discussion.
Yeah, and then you had and to finalize there, you had mentioned the fact that the election year. Again, if you look at the employment numbers, etc., the job numbers, that's why I'm saying, hey, go do your own research there. It looks as if the administration is doing everything they can to keep those numbers feeding the market, to say the very least. Go ahead, Phil.
Right. But also at the same time, unemployment has now been on a positive trend for at least a year. So that could start to break out. And actually, I think there was a jobs report yesterday that came in a little hot, beat expectations, and it kind of reinvigorated the market that there may be rate cuts coming sooner than they had just anticipated in April. Back to the auto market. Let's get into this. Supply. New inventory is up 50% year over year. Still down 26% compared to 2019, but day supply came in at 75 days, 39% higher than the same time last year. Used is up 6% year over year. It's essentially flat against pre-pandemic levels at around a day supply of 45 days. Looking at retail sales now, new has essentially been level over the last 3 weeks, but it's been holding 8% higher than the prior year. Used stopped declining in April, but it is also up 9% year over year. Also very reflective of our dealership statistics year over year as well. Now, here's where things get a little interesting.
The automaker said, things were going pretty good for a couple of months. Let's mess this up a little bit.
Let's mess this up. 0% offers ended the year at 5.4% of vehicles qualifying with a 0% offer. They ended the year at that level. Less than 3% APRs hit a high point for the last 2 years in February of this year. Since the start of the year on new vehicles, those have declined every single month. Since February on less than 3% APRs, those have declined every single month. Some lucky consumers can still find under 3% offers, but that share has nearly been cut in half since the start of the year.
Lucky customers. Are you the lucky one?
Now, let's talk about average auto loan rates. These have moved higher in 2024. New and used both saw slight declines in March, but new is actually up 14 basis points and up now 87 basis points year over year. Used declined by 7 basis points in April, still up 55 basis points year over year. And so right now, as we are now into May, tax refund seems to be kind of fading into the background as April ends. And we saw less of a boost of vehicle sales this spring, specifically spending on durable goods because of this high interest environment that we remain in. Rates remain around 24-year highs, and there are expectations of rates going lower. And so there's really not much urgency from consumers right now. Still, we do see sales holding up over last year. As I showed right here, sales are still up 8% for new, up 9% for used. And so people are still buying cars.
Shotgun, Phil, are people willing to drive shorter right now to get a car? Or are they willing to buy from farther away? Answer.
Nearly double as far as they would in 2019.
If you are out there, Mr. Dealer, and you, Mr. Dealer, I'm for the dealers. I'm for the people. Okay. If you would like to get more customers and get more lead volume, number one, you can expand radius, but you can only expand radius and have a high level of success if you have an extremely competitive offer. Because what the hell are the customers looking for from that far away? They're looking for the fact that thing he showed about 2.7% of people can get a 0% offer and 12.3% can get under 3% offer. They're trying to find those. That's the answer. So they will go farther, but if you go and expand your radius and you don't have those offers, do not blame your agency. Do not do it because it will fail.
That's the Market Minute.
That's the Market Minute. My name is Steven.
My name's Phil.
Grab your quiver, grab an arrow. See you next month.